Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head the G10 FX strategy team here at NatWest, sitting in the US, and I'll be your host today. And today we're going to be focusing on the UK and the US. A lot of drama in the US this week, and some potential drama to come next week in the UK with the Bank of England meeting coming up. So to talk about this, I'm happy to be joined by Paul Robson, who also covers G10 FX with me in London. Thank you very much for joining, Paul.
Well, thanks very much for the invitation. As you said, lots of drama around, certainly this week and next week. That's always a good sort of start to any podcast, I think. So a lot to get through today. Looking forward to it.
Yeah, lots to discuss. So I want to start with you talking about the UK. We do have the Bank of England decision next week. And it's interesting, the Bank of England seems to be maybe trying to chart a bit of a different course than a lot of its peers here. What are you thinking for the Bank of England next week?
Well, I think the first thing to note for the Bank of England is next week's policy meeting, the August meeting, is surprisingly uncertain. If you look at how markets are pricing it, they essentially think it's a 14 basis points of easing priced out of could get a quarter point, 25 basis points of easing. And that's quite unusual, especially given that it could be the first that sees a rate cut, a sequence of rate cuts, the start of an easing cycle. Normally would have expected guidance to have been a little bit clearer either way, either pushing back on market pricing of early cuts or giving them confidence that they should price it with 100% confidence. You can never be 100% confident, but the fact that we're in the middle suggests that, sterling and UK assets might move when we get that result, because some people will be surprised by the result. Here at NatWest, our economics team think we won't get a rate cut at the August meeting. They think that probably comes a little bit later, potentially at the November monetary policy report and meeting, when we'll get a monetary policy report as well. I think that the uncertainty stems from the fact that we haven't really heard very much from the Bank of England. They had that self-imposed radio silence through the UK general election, and we've only really heard, I think importantly, from the chief economist, Hugh Peel. We've heard from some other members, but I think their views were always very clear, and regardless of the data, they undoubtedly would probably have not changed their view. And of course, we had the last set of minutes that said for some members on the committee, the decision to not cut rates was finely balanced. And we were hoping for a little bit more sort of insight into that. Who are these more finely balanced members? And when we heard from the chief economist, he seemed not to be one of those people. Inflation uncomfortably high. We're going to need a number of data points before having confidence about cutting rates. That doesn't feel like someone that thought the decision was finely balanced. I mean, it could be Governor Bailey, but would he vote for a cut when his chief economist wasn't? Now, of course, he could. There's nothing stopping him, but it sort of leans that way to not getting a majority. And there's additional uncertainty because we have a new member on the MPC, and we also have a relatively new member on the MPC, and we don't really know how they would vote. Now, they could easily vote for a cut if they were swayed by the governor, but this isn't the Fed. It's not about consensus building. Individual members can have individual votes. So when we put all that together, we think that rates will remain on hold next week.
So I want to ask you about what this means for sterling. And I know, frequent listeners of this podcast will know that we have been operating in this sort of framework of early versus late tighteners. And it feels like the Bank of England is sort of carving themselves out as potentially firmly in that camp. How are you thinking about this for sterling here?
Well, I think it's a positive. I think as you described it just there, this idea that you have a set of central banks that are potentially cutting later, and you have some early easers. But I think optically it looks good for sterling and the Bank of England, because I know it's balanced between, I'm going to ask you about this in a minute, Brian, but where does the Fed fall? Could they go a little bit early? Could they go in September rather than December? But there is a chance that the Bank of England is cutting after the Fed. They certainly are going to cut after the ECB. The ECB could have ended up cutting, twice by the time that the Bank of England moves again. You've got the S&B, you've got the Riksbank, you've got the Bank of Canada, who came through with a second cut, back cuts this week. So if we think interest rates matter for currencies, then that should be supportive of the currency. I think there's other parts of this as well. Higher terminal rates in the easing cycle, higher real rates once you adjust for inflation. I think that's supportive. But I think the key thing for sterling is actually away from monetary policy. I think it's about the prospect of portfolio flows into the UK. It feels that international investors are underweight UK assets, and if they're bought unhedged, that could be supportive. And we certainly have a more political backdrop that is stable now, and that's quite a significant change in recent years. And maybe international investors have avoided investing in the UK. And if we do get political stability, maybe we'll see some inflows. And when I looked at continental Europe and in the US, and I'm sure we're going to talk about this in a minute, an island of relative political stability, which I think is important. So capital inflows. And also that the prospect of political stability might help investment domestically or FDI. It might not be a game changer, but it's certainly not negative. If companies feel more confident in the outlook, relatively unchanged government policy, then that's supportive. I think for sterling, there are a couple of risks that we have to always be mindful, and we have to be balanced. So the first one is corporate selling of sterling, both European corporates and domestic corporates, because there is a large bilateral trade imbalance between Europe and the UK. And if they choose to hedge at these levels, at the extremes of sterling, then that matters. I think the idea that sterling does relatively well is quite a widely held view in market. So it might be already in the prices, I would say, or positioned for. I think that's important. And also because we expect this sort of equity inflow into the UK to cover the current account, if anything, that undermines global equities. And as we were recording this podcast, global equity markets have been quite volatile. That might mean that those flows don't come and sterling weakens. So very much concentrated on corporate selling potential, positioning, and also equities. But we've covered a lot from the UK. So we had that sort of monetary policy angle, and we've also got that political angle and growth. But when I look at the US, obviously you quite rightly said it's been quite a dramatic couple of weeks, and the drama sort of built at the weekend with Biden stepping down. But I was interested to hear about how you're seeing the shift from Biden to Kamala Harris and what that might mean for how investors should think about the dollar here.
Yeah, it has certainly been a dramatic couple of weeks here in the US on the political calendar. The most recent being, as you mentioned, Biden dropping out of the presidential race, and the Democrats quickly coalescing around Kamala Harris as vice president. There's sort of two questions here. The first one is, what should FX investors be thinking about Biden versus Harris? And then a second one, which is Harris versus Trump. And we'll come to that second question in a little bit, but let's focus in on this first question, which is, what is the difference, and should there be a difference, and how should markets be thinking about Biden versus Harris? And what we have been thinking here is that there is not a material policy difference between these two. Kamala Harris is the current vice president. She is a member of the Biden administration. She has been campaigning on the Biden administration platform for this entire cycle. There's probably a limit to how much specific divergence you would see between a Harris presidency and a Biden presidency. More broadly speaking, the Democratic Party, the decision to sort of push Biden out of the top seat was not made because of policy differences. It was made because of his seeming electability issues as well as his age. And so this is quite important to highlight, because if Biden had been pushed from the top seat because of policy, then there would potentially be a real policy implication that comes with a change at the top of the ticket. In this case, he was not removed because of policy. If anything, Biden's policies, for the most part, are generally liked within the Democratic Party, especially within the leadership. The broad tenets of Democratic policy, which a Democratic policy platform, which includes no new taxes on anyone making under $400,000 a year, increase in corporate tax rates, increase in taxes on wealthy individuals to fund additional additional social spending. So, for example, potential, ESG green investment, any sort of extension of child tax benefits. Broadly speaking, more pro-regulatory, more sort of, more skeptical towards fossil fuels, foreign policy support for Ukraine. All of that is widely shared across the Democratic Party, and between Harris and Biden, I think certainly that platform is going to remain very similar. And so for FX investors, I don't think we should be thinking about Harris any differently than Biden. Instead, I think we should be thinking about the potential Harris presidency as it impacts the entire race, because of course we know in November it's not going to be Biden versus Harris. It's going to be, in this case, most likely Harris versus Trump.
Yeah, so just maybe delve a little bit more deeply into that difference between, or how you see the it playing out between Harris and Trump 2.0.
Yes, and so this is that second question, right? So we think FX investors in the dollar, I think, hasn't really responded that much to the specific potential changes. I should mention that Kamala Harris, when she was in the Senate, was a bit more sort of left-leaning than Biden, who was a pure centrist. And so I think that's probably, if you're thinking about the balance of risk, it probably leans a little bit more towards what you consider the traditional Democratic sort of platform, a little bit less center, a little bit more left, but the broad strokes are the same. For FX investors, we have been consistently saying, and we continue to think, that the race for the dollar will all come down to Trump. If we see a Trump victory, then we'll be pricing in Trump-related scenarios. And if we see a Trump loss, we will be pricing out Trump-related scenarios, and that will be the first-order impact on the dollar. And so Biden and Harris at the top of the ticket does not change that dynamic in a meaningful way. We're still probably thinking that a Trump loss is less about pricing in the specific Democrat and pricing out a Trump victory. And so when we think about Trump, we think that a Trump victory likely leans positive for the dollar on a number of fronts. The first one is the potential for additional fiscal stimulus, and with it, higher yields in the US. We consider Trump to be walking, talking policy divergence, that if he brings with him additional expectations of fiscal stimulus, additional expectations of inflation, that could throw this sort of this glide path of Fed expectations, which is clearly angling up for the start of an easing cycle to begin somewhat imminently. That could throw that into a little bit of uncertainty if we were to get the market pricing additional fiscal stimulus in the US and pricing potentially extra growth momentum at a time when it seems like not just the US cycle, but the global cycle is starting to finally show clearer signs of downshifting. The other angle for Trump and the dollar is the resumption of the trade war, particularly against China, that we think that risk of additional tariffs on China is something that could come very quickly. We've seen in recent days how expectations for shifting expectations for growth in China can have wider repercussions for FX markets. But one of the obvious ones is that external-based economies, manufacturing-linked economies that have greater links to China are probably more vulnerable than the U.S. is if the U.S. starts to pursue a much more active tariff war. And so what we saw during the first Trump trade war was the dollar benefited as trade wars seemed to widen that expected relative gap between economies that are more externally focused versus the US, which is services and consumption focused. And so we do think that a Trump victory does lean positive for the dollar. So what we have seen since Harris took over the top of the ticket was the market is pricing down expectations for a Trump win. Betting markets had Trump at almost 70%. In the aftermath of the failed assassination attempt. That was sort of the peak of Trump expectations in the market. Now we're down closer to just below 60%, now that we have Biden having stepped away and Harris coming in. Just as importantly, the markets are sort of pricing away from the risk of a full Republican sweep. If the market sort of consensus or the thinking here was that Biden was going to be such a weight on Democrats that it was going to really hurt them down ballot. And we know for fiscal stimulus, it doesn't matter. It's not as important who the president is. It matters whether or not you have united control, because when you don't have united control, nothing gets done. So for fiscal stimulus, markets, I think, in the aftermath of the assassination attempt, we're starting to price more clearly towards the risk of not only will Trump win, but we will have Republicans all across the country will outperform. We could get these greater fiscal scenarios. So the big impacts we've seen from Harris, the change over to Harris on the broader race, is I think markets have correctly reduced the odds of a Trump victory from what we were thinking 70% odds for a Trump victory was already starting to look a little bit overpriced. Back closer to 60% we think feels more fair. Additionally, markets have reduced this risk that we have a sweep scenario come through. And a sweep scenario is the one where a lot of these potential fiscal impulses become a bit more clear. And so in both cases, that's how the market has reacted. In terms of the dollar, this hasn't made, I would say, a massive influence, the specifics of the presidential race. And that in part, I think, reflects some uncertainty over what a Trump presidency actually means for the dollar. I mentioned the core reasons why I think a Trump presidency is positive for the dollar, but we do get pushback on this idea because we know that Trump wants a weaker dollar and he wants lower rates. And so if you think that Treasury's strong dollar policy is potentially at risk under a Trump presidency, or you think that Trump is potentially going to make a move on Chair Powell and try and replace him with someone who might be more open to cutting rates faster, those are clear risks to the dollar that we certainly get quite a bit of pushback on the value of the dollar in a Trump presidency. And so as we think about the market changing, sort of rearranging the deck chairs when it comes to who can win the presidency, we should always acknowledge that the dollar trade on a Trump victory is not set in stone. There is the consensus is not obviously always pointed in one direction. And I think that might be reflected here in the sense that the dollar in some cases, we haven't seen obvious Trump, it's not been so obvious that when Trump is moving higher in betting markets, dollar is strengthening, and when Trump is moving lower, dollar is weakening.
You were talking about the dollar there and how I think the dollar is reacting. Obviously, the other main driver of the dollar is interest rate expectations and the data, and they've been moving around a lot as well. So interesting to see that a September rate cut from the Fed, 100% price in, or largely completely price in. I was just wondering what you thought about that pricing, given the evidence that we've been seeing, and how you expect that Fed outlook to play again for the dollar against that backdrop of these political risks, as you say, which are moving the dollar as well. You seem to have these two heavyweight boxers sort of slugging it out. But how are you thinking about the Fed?
I mean, that is a great way to think about it, where you have these two very big macro drivers, one that's happening in real time and one that is an expectation, which we know will have major impacts when it does happen in a few months from now. And I think investors, are sort of rightly struggling to find that right balance between these two, because if you believe that a Trump victory is a positive for the dollar, which is still, I think, the market consensus, albeit a lesser one, now that Harris is assumed at the top of the ticket rather than Biden, this is happening against a U.S. economy that's clearly showing some signs of downshifting. The labor market has slowed, and the speak from the Fed has become a lot more confident in their ability to lower policy rates, not just because inflation is showing signs of moderating, but also because the labor market behind it is not nearly as tight as it was even 6 months ago. That some of those expectations for slower, more balanced labor market seem to be coming into place. And so this leads us into the July decision next week, where I would say that there are some people even wondering whether the Fed should be cutting at the July meeting. Now, our expectation and the overwhelming consensus is that the Fed will not cut the policy rate next week. But as you mentioned, Paul, the markets are now, interest rate markets are now pricing about 100% odds that the Fed cuts the policy rate by 25 basis points in September. So what that means is the market is very clearly biased towards this meeting being a moment where the Fed opens the door to that conversation very clearly, effectively that all of the guidance not only turns dovish, but it sort of sets the stage for the Fed will actively consider whether it's appropriate to ease the policy rate at their next meeting. Now, this is probably where you get into the nuance for the dollar, because the market's clearly expecting something specific from the Fed that opens that door to September. But our view is that we still have plenty of time between now and the September meeting to open that door. There's still, we're still a month and a half away from that September meeting. And importantly, not only do we have a couple more months of inflation data to get through between now and September, We also have the Fed's Jackson Hole conference at the end of August, at which the Fed chair often speaks and is expected to speak and give a high-profile policy speech. So if you're thinking about when does the Fed need to open this door, we think it's right the Fed is going to be opening this door. All the communication and the data have been pushing in the direction of letting a September move be on the table. Do they need to open that door very clearly with their discussion at the July meeting, or is this something that could happen at a later event, say Jackson Hole, for example? And my contention is that this may be something that could happen in August or maybe even in early September, when the Fed is even closer to this point, and if the data allow them to be even more confident, signal in that direction. And so what we may come to is the market seeing clear signs of dovish drift from the Fed communication, which is wholly consistent with what we've seen from speeches from other Fed members. Think Governor Waller, for example, giving a speech about getting closer to the point at which the policy rate can be cut, right? But do you go all the way to the official signaling, effectively opening that door and saying, at our next meeting, we will consider cutting the policy rate, or we will debate cutting the policy rate? If that's the standard the market is looking for, because we're 100% priced for September, maybe we don't quite reach that. But I do think that the market, the market's assumption right now is that September is fully in play. And I don't think the Fed is going to do much to change that. So dovish evolution for sure, I think, is right based on the direction of the data, direction of the commentary that we've had from the Fed. But what I worry about is because the market's 100% priced for a cut in September, I wonder if anything short of the Fed fully opening that door ends up leaving a little bit of something to be desired. And I just think that there's no need to clearly put September on the table today when you have plenty of opportunities to do so, particularly the Jackson Hole meeting. And so that's where I think the nuance comes in, is if the market's looking for that firm signal of September at the July meeting next week, I just don't know if that's going to be delivered. Although I don't think the Fed's going to say anything that'll convince the market that September is not live. I just don't think they're going to give that exact symbol.
Yeah, I mean, it feels like it's going to be a super interesting sort of 3 to 6 months in FX rates with the dollar front and center. I think the price action in the dollar that you're seeing, I think people are really struggling to price both those risks. If you think about the beginning of the year, I think the hope in markets was that US inflation would come down, the Fed would start easing, everyone else would start easing, some kind of sequencing, some would go a little bit earlier, some later. And then later on in the year, you could start to think about the US election, but all of a sudden you've got the Fed and the election all coming at the same time. As I say, you've got these two competing forces. And it feels like it's going to lead to sort of maybe more volatile markets, but not range breaking. But it's like you say, if the market could be disappointed if the Fed don't signal that September cut in rates. So all to play for, I think, for the second half of the year into the new year.
Yeah, Paul, and you mentioned also when you were talking about sterling, the importance of the consensus, right? Like what's positioned. And certainly in these last couple of weeks, we have seen the most clear movers in FX space have been where positioning is sort of most obvious, right? Where it seems like the biggest movers have been ones where positioning has all been sort of one way, and you've seen clearing of those positions. So maybe not necessarily a big change in either market's fundamental backdrop or big change in market's expectations or higher convictions. If anything, it feels like some of the biggest movers have been where positioning has been doing a lot of that work. You think about dollar yen, for example, as we head into a Bank of Japan meeting next week, where expectations are pretty lofty for the BOJ to make some big changes. That's been one place where it feels like positioning clearing has been a big driver. You've also seen in U.S. equities as well, certainly in recent sessions, you've seen some signs that some of the most heavily positioned or heavily consensus long equity positions have seemed to start to show signs of coming off here. And so, as you mentioned, I think it's super important we think about not just the global macro backdrop where there's a lot of uncertainty, but look at where positioning, where positioning lies. Always be mindful of where positioning is, because it seems like in an environment where a lot of people are struggling for high conviction, positioning is going to be really important to decide where there might be either vulnerabilities or opportunities in FX and global markets. So with that, I think we've covered a lot of ground, Paul. I want to thank you for joining. And to our listeners, thank you as well for joining. If you enjoyed this podcast, please consider liking and subscribing to our channel so that you can get the latest content the moment it's released. Thank you very much.